Well, there's been a lot of talk lately about the ceasefire supposedly calming everything down and about the Strait of Hormuz supposedly getting back to normal. So in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and a lot more confident in your investment. Now today is Saturday, April 11th in New York, so go ahead and comment below what day and date you're watching from. And real quick, if you value the way I break this stuff down, support the channel by subscribing and by commenting John AG Best. That really does help more than people think. So, in case you've seen some of the chatter floating around, it usually goes something like this. The ceasefire headline hit. Oil cooled off a bit from the panic highs. Gold didn't blast straight upward. Silver looked sleepy. Therefore, the whole thing must be fading. Sounds simple. Sounds clean. Sounds like the kind of story people want after a rough stretch. But when you start actually checking the facts, that tidy little story begins to wobble pretty quickly. Because the main issue never really disappeared. The strait still is not back to normal. And that matters a lot more than one hopeful headline. According to Reuters, vessel traffic through the Strait of Hormuz stayed dramatically below normal even after the ceasefire announcement. They cited shipping data showing only a small fraction of the usual flow getting through. And some of the major carriers were still talking about recovery in terms of weeks, not days. That is not a market plumbing detail you brush aside. That is the story. That is the bottleneck. That is the thing that keeps pressure inside the system, even while people on television try to tell you everything is calming down. And Hormuz is not just any shipping lane. According to the U.S. Energy Information Administration, it remains the world's most important oil transit choke point. Roughly 1/5 of global petroleum liquids consumption and around 1/5 of global liquefied natural gas trade move through that passage. So if that route remains impaired, you are not talking about some side issue. You are talking about a pressure point for energy, freight, fuel costs, inflation expectations, and confidence all at the same time. That is why I don't think you can judge this story by asking one tiny question like, why wasn't gold up huge today? That is too small. You have to ask a better question. What happens when a critical energy artery is still not functioning normally? Inflation is already sticky, and markets do not know whether the next chapter is reopening, escalation, slowdown, or policy rescue. That is the real question. And when markets are trying to price 4 different futures at the same time, you do not always get the obvious reaction on the first day. Sometimes you get hesitation. Sometimes you get choppiness. Sometimes you get this weird half-relief, half-anxiety tape where nobody fully trusts the headline, but nobody wants to be the fool who ignores it either. That is exactly the kind of setup we have right now. Now, I want to challenge one lazy idea that keeps getting repeated, and I think it is a mistake. A lot of people hear energy shock and immediately think, okay, that means gold and silver must go straight up with no interruptions. Maybe over a long enough timeline, the macro damage does end up supporting precious metals. I get that. But in the short run, that is not always how this works. Sometimes a higher oil price acts like a tax on the economy. It hurts transport. It hurts margins. It hurts household budgets. It hurts travel. It hurts sentiment. It hits businesses and consumers before it shows up in every clean narrative. And if it squeezes growth hard enough, markets can start worrying about slowdown and liquidation at the same time they are worrying about inflation. That is not a contradiction. That is the sequence. Inflation pressure can hit first in the headlines, then growth pressure can show up in the economy, then liquidity stress can hit the market, then policymakers can come running with support. That is one way these things unfold. So if gold pulls back on a random day, or silver goes sideways for a little while, that does not automatically mean the bigger thesis is broken. It may just mean the market is stuck between pricing the inflationary shock and pricing the growth damage. And speaking of inflation, the official US data did not exactly come in whispering sweet nothings to the market. According to the Bureau of Labor Statistics, headline consumer inflation in March rose 3.3% from a year earlier. On a monthly basis, energy jumped by more than 10%, and gasoline surged by more than 20%. In fact, BLS said that monthly jump in gasoline was the biggest since that series was first published in the 1960s. So when people say maybe the inflation scare is over, I am just not seeing that in the actual release. And if you look at the Federal Reserve's preferred inflation measure, the message is not exactly mission accomplished either. According to the Bureau of Economic Analysis, the latest personal consumption expenditures price index was still running in the high 2s year over year, with core inflation still above where the Fed wants it. So even before you assume the full ripple effect of higher energy costs has worked through transport, goods, services, and consumer expectations, you were already dealing with inflation that had not fully come home. That matters. It matters because this is not happening in some pristine economy with zero other problems. It is happening in a system that was already carrying a lot of debt, already carrying fiscal strain, already carrying valuation questions, and already carrying a market obsession with when the next policy easing might arrive. Now let me zoom out for a second because this is where the story gets bigger than one commodity or one headline. If you have a supply shock around a critical choke point, then even a ceasefire does not instantly erase the damage. Ships do not teleport. Cargoes do not reappear by magic. Insurance does not go back to normal because someone posted a hopeful message online. Routing changes take time. Inventories have already been drawn down. Contracts have already been disrupted. Freight has already been repriced. Risk managers are already leaning more defensive. And once that process starts, the after effects can keep showing up well after the first scare appears to fade. Reuters reported that pump prices in the United States were still expected to stay elevated despite the ceasefire because sellers wanted real operational clarity before bringing prices back down. In other words, the market does not trust the headline by itself. It wants proof. And that is exactly how real-world systems behave when trust has been damaged. They do not normalize on command. They normalize slowly, and slowly is expensive. From other recent Reuters reporting, even analysts looking at a more optimistic case were still warning that a slower recovery in Hormuz flows would create upside pressure for oil. One bank kept its baseline forecast but said delays in restoring normal movement through the strait could still push prices higher than expected. Another report, citing the U.S. Energy Information Administration, said fuel prices could remain elevated for months even after the route reopens because the risk premium and the logistical tangle do not disappear overnight. That is another huge point. Even a better headline tomorrow does not instantly erase the inflationary shove that has already hit the system. So when somebody says, well, the truce means we are done with this, I think they are underestimating how long physical disruptions can echo. They echo through inventories. They echo through refiners. They echo through trucking. They echo through airlines. They echo through shipping contracts. They echo through household budgets. And they definitely echo through inflation psychology. That is one of the things markets are struggling to price. Now let's bring this back to gold and silver. Why wasn't gold screaming upward every hour? Why was silver basically doing a whole lot of nothing for stretches? Well, think about it like this. When the road ahead is foggy, you do not always slam the gas. Sometimes you grip the wheel harder and wait for the visibility to improve. Markets do the same thing. They widen out mentally before they commit directionally. They get cautious before they get confident. And some of the most dangerous macro setups are the ones where the price action looks calmer than the underlying reality. According to Reuters, gold still headed for a weekly gain even while traders kept reassessing the durability of the ceasefire, the trajectory of oil, and the implications for interest rates. So the market did not exactly shrug this off. It just did not give everybody the clean vertical confirmation they wanted on command. And silver, as usual, is even trickier, because silver wears two hats. It is monetary, and it is industrial, so it can respond to inflation fear, risk appetite, economic slowdown, investor flows, supply constraints, fabrication trends, and liquidity stress all in the same month. That is why silver so often makes believers look early and skeptics look silly, sometimes in the same quarter. It is not a one-lever market. And if you dig into the fresh silver data, the longer-term backdrop still looks tighter than the sleepy chart might suggest. According to the Silver Institute, the silver market is expected to remain in deficit in 2026 for a sixth consecutive year. They also said the market would continue relying on releases from above-ground inventories, which is just a polite way of saying the system is still leaning on existing stock to bridge the gap. That is not the language of comfort. That is not the language of abundance. That is the language of a market still under pressure beneath the surface. Now, to be fair, not every part of the silver story is pointing in one direction all at once. The Silver Institute also said photovoltaic demand is likely to soften because manufacturers keep finding ways to use less silver. That part is real. We do not need fantasy to be bullish. But the same outlook also pointed to support from areas like autos, consumer electronics, grid-related applications, and the build-out around data centers and artificial intelligence. So if somebody tries to reduce the whole silver thesis to one sentence, like, well, solar is using less silver now, so the story is over, they are leaving out a big piece of the puzzle. A big piece. Because silver demand does not come from one doorway. It comes from several. And some of those doorways are opening wider, just as another one narrows a bit. That is how a real market works. Now, another thing I think people keep misunderstanding is the difference between visible selling and true abundance. There has been a lot of talk that more silver is coming back to the market from the retail side. Fine, that may be happening, but not all selling is happy profit-taking. Some of it, according to dealer commentary in the broader market conversation, appears to be people needing cash or liquidating inherited metal they never wanted to hold. That is not the same thing as fresh structural supply. That is stress selling. That is a symptom. And even when metal comes back, it still has to be sorted, melted, recast, shipped, and delivered in the form that the next buyer actually needs. The wrong form in the wrong place at the wrong time does not solve a real tightness problem. That is one of the reasons premiums can stay sticky longer than chart watchers expect. And I am not convinced that story is fully over. Now, on the investment side, the Silver Institute also noted global exchange traded product holdings around 1.33 billion ounces. That is a huge stockpile that can still swing market balances depending on whether investors are pulling metal out or pushing money back in. So yes, ETF behavior matters, a lot. It can change the visible deficit story, it can change the pace of tightening, it can change how comfortable the market feels. But even there, I think the bigger point is this: a market that can still run sizable deficits while leaning on inventories is not some sleepy little backwater. It is a market with underlying tension. And underlying tension matters a lot when you start layering geopolitical shocks on top of it. Now let's talk about the mining side, because this is where the pricing environment starts showing up in real corporate behavior. According to First Majestic, the company reported record annual silver production for last year, and it also announced a restart plan for the Jarrett Canyon gold mine. The company said it planned to invest tens of millions of dollars during this year to support that restart, with production expected to begin in the second half of next year. Now, why do I care about that? Because high metal prices are not just a chart story. They change what management teams are willing to fund. They change what projects look economic. They change how capital gets allocated. That is not noise. That is the industry voting with real money. And when producers are making longer-term decisions based on stronger price assumptions, that tells you something important. It tells you the people closest to the rocks are not behaving like this is the end of the road for precious metals. Now, does that mean every miner is automatically a winner? No, of course not. Costs matter, jurisdiction matters, execution matters, grades matter. Plenty can still go wrong. But stronger cash generation and restart decisions do tell you something about the environment. They tell you this is not a dead market. Now, I also want to talk about the policy response side, because this is really the heart of why I stay constructive longer term, even if the short-term tape gets messy. If energy stays elevated and growth starts cracking, what do policymakers usually do? They intervene. Maybe not instantly, maybe not gracefully, maybe not in the form people expect, but they intervene. They cut, they support, they lend, they subsidize, they backstop, they redefine the emergency until the response sounds justified. That is the pattern. And every time that pattern repeats, the longer-term case for scarce monetary assets picks up another layer of support. That is why I keep saying a deflation scare is not automatically bearish for metals over the full cycle. Sometimes it is the setup. Sometimes it is the thing that frightens the system into delivering the exact policy response that eventually supports gold and silver even more. That does not mean the path is easy. It does not mean silver cannot scare people first. Silver loves doing that. But it does mean you should be careful about confusing short-term turbulence with long-term invalidation. Those are not the same thing. And you can already hear the policy split in the current conversation. On one hand, central bankers still have to sound disciplined because inflation remains above target. On the other hand, even recent Reuters coverage of policymakers showed officials acknowledging that higher oil prices could feed inflation, while the eventual growth impact remained uncertain. That tension is exactly the trap. They cannot sound relaxed, but they also cannot fully promise a higher for longer path if the real economy starts deteriorating more quickly than expected. That kind of policy fog matters, because gold does not only price inflation, it also prices policy credibility. And silver, over a longer horizon, tends to price the combination of monetary distrust and industrial necessity. Now, there is another subtle point here that I think deserves attention. Gold and silver are not just pricing inflation. They are also pricing confidence, or the lack of confidence, in the institutions managing inflation, growth, war risk, energy supply, debt, and fiscal reality. And let's be honest, the United States does not exactly project the image of a system racing toward clean budgets, tight discipline, and voluntary pain. Nobody really believes the easy fix is around the corner. Nobody really thinks the answer is less debt, less spending, less intervention, and more patience. The moment growth wobbles hard enough, the pressure for support returns. That is the world we live in. And that world is not naturally hostile to gold and silver over a longer horizon. It is actually the kind of world in which they tend to keep finding reasons to matter. Now, let me bring in another layer of fresh context. Reuters just ran a piece on how the upcoming U.S. earnings season would test companies already rattled by war-driven energy prices. Think about what that means. This is not just a metal story and not just an oil story. This is a margin story. This is a consumer story. This is a corporate guidance story. This is a sentiment story. If higher energy prices keep feeding through the economy, then companies have to either absorb the cost, pass it through, or disappoint investors. None of those options is exactly friendly to the idea of a soft, painless glide path back to calm. And if the corporate side starts wobbling, the pressure on policymakers rises again. That is how these things connect. One market talks to another. One stress leaks into the next. That is why I do not like these simplistic takes where somebody says, oil did this, gold did that, silver did nothing, therefore case closed. No, that is not how interconnected systems behave. They move in waves. They move in chains. They move with lags. And investors who only stare at a single candle often miss the bigger transfer of pressure happening underneath. Now, let's talk about consumer strain for a second, because this part matters more than people think. Reuters also reported that Americans were giving the economy historically poor marks as inflation accelerated again, with energy costs playing a big role in that deterioration. That matters because once fuel and daily necessities squeeze households, you start changing behavior. Consumers cut, they postpone, they borrow, they liquidate. And yes, sometimes they sell assets. That is one of the reasons I take the retail side of the precious metals market seriously. Distress selling can increase short-term supply, but it also tells you the economic stress is getting more personal. And when it gets more personal, politics gets louder. That is another form of event risk. Now, if you're successful, share your success story in the comments so others can stay motivated. Because a lot of people out there are under pressure right now, and hearing from somebody who stayed disciplined and made it through a hard stretch can actually help more than you realize. There is also a geopolitical humility that I think investors need right now. Nobody can seriously claim to know exactly how this resolves, how fast traffic normalizes, how durable the truce is, or whether another escalation interrupts the whole process again. Reuters reported that the ceasefire itself still looked fragile, and that even the surrounding diplomatic presentation reflected uncertainty about its terms and durability. So if even the political side of the story still looks blurry, why would you expect the market to give you a clean, simple, one-day answer? It won't, not reliably. And that is why I think patience matters more than theatrics right now. There is also an important distinction between price and duration. A short, sharp shock can be absorbed one way. A slower, lingering disruption gets absorbed another way. The longer the root stays impaired, the more businesses start adapting in ways that can keep prices sticky even after the original disruption begins to ease. They change sourcing, they change hedges, they build in more cushion, they hold more inventory where they can, they demand higher margins for uncertainty, and all of that can keep inflation firmer than people expect, even if the daily news flow feels less dramatic. That is why I am careful about these one-day relief rallies in oil, or these one-day pauses in gold and silver. A market can breathe without being healed. Big difference. Another fresh angle here is the way energy feeds into diesel and jet fuel, not just gasoline. Reuters reported that market observers were still warning about elevated diesel and jet fuel pressures because the region matters so much for those flows, and because the disruption risk had not been fully removed. Diesel matters for freight. Jet fuel matters for airlines and travel. Freight and travel matter for everything else. So when you see that part of the market stay elevated, you are looking at the possibility of further pass-through into the broader economy, not just pain at the pump. That is another reason I think the inflation issue is more persistent than some people are assuming. And no, I am not rooting for chaos just for vindication. So I am not sitting here hoping for breakage. I am hoping for fair repricing in an environment where the market mechanisms still function well enough for people to make rational decisions. That is the healthier outcome. That is the outcome adults should want. Now, another silver-specific point that deserves more attention is how tight markets can hide behind normal-looking price action when above-ground stock is doing the balancing work. If deficits are being patched by inventory releases, then the quote screen can look less dramatic than the underlying draw. That can create a false sense of comfort. People look at the chart and think, well, if it were really tight, surely the price would already be screaming. Not necessarily. Sometimes the inventory is the shock absorber until it isn't. Sometimes the market looks calm precisely because the buffer is being used. And once confidence in that buffer changes, the tone can shift fast. That is one reason I watch silver so closely in a backdrop like this. Now, I also think the artificial intelligence and data center angle is more important than it first appears. People hear that phrase and think software, chatbots, semiconductors, maybe cloud computing. Fine, but the build-out is physical. It needs servers, switches, connectors, electrical gear, backup systems, higher capacity grids, cooling systems, and all kinds of infrastructure that lives in the real world. Some of the silver demand support the Silver Institute talked about is tied to that broader physical build-out, not just some abstract digital theme. So when one demand category softens and another category strengthens, what matters is the net pressure on the market, not the loudest single headline. That is the kind of nuance I think gets missed. And if you look at the way policymakers and investors are talking right now, nobody sounds fully comfortable. Some are still leaning on the idea that economic fundamentals are okay beneath the noise. Others are warning that the longer this drags on, the more growth slows and the more inflation sticks. Markets are floating between those two poles: confidence and caution, relief and distrust, hope and damage. And precious metals tend to matter more, not less, when the system starts speaking in that kind of split language, because split language usually means split confidence. And split confidence is fertile ground for hard assets. Now, let me give you a counterpoint because I think that is important too. There is a version of this story where the ceasefire holds better than expected, traffic improves faster than feared, energy prices settle down, and some of the immediate pressure comes out of the macro picture. That could happen, and if it does, you could absolutely see some of the urgency come out of the metals trade in the short run. You could see silver remain choppy, you could see gold consolidate, you could see people get bored. That is possible. But here's the problem with relying on that outcome too confidently. The damage already done does not vanish instantly. The inflation pulse already printed. The shipping disruption already happened, the policy uncertainty already widened, and the silver market was already expected to run another deficit anyway. So even in the more optimistic scenario, a lot of the underlying ingredients do not simply disappear, they soften, maybe, but they do not vanish. And I think that is why the bigger setup still matters. If you are a longer-term investor, I would argue the more useful question is not, why did silver not explode today? The more useful question is this: are we living in a world where a critical energy choke point can remain impaired? Inflation can re-accelerate through energy, policymakers can become more reactive, and a structurally tight silver market can keep leaning on inventories while mines and producers respond to stronger price expectations? Because if the answer to that question is yes, then I think the longer-term precious metals case is still very much alive. And from where I am sitting, the answer still looks like yes. Now let me add one more thing on silver specifically, because this is where I think the market can still surprise people later in the year. Silver rarely asks permission before repricing. It tends to spend long stretches lulling people into thinking nothing is happening, and then once enough pieces line up, it starts moving in a way that feels obvious only after the fact. A market with recurring deficits, large investment holdings, mixed but still substantial industrial demand, and a macro backdrop full of inflation risk, growth risk, and policy uncertainty does not need perfect conditions to tighten further. It just needs enough competing claims on the same metal. That is what makes it interesting. That is what makes it dangerous to dismiss. And that is why I keep saying I am less interested in whether silver looked sleepy on a random day than I am in whether the underlying setup keeps developing in the same direction. Right now, I think it does. So let me land the plane here. The ceasefire headline did not magically normalize the Strait of Hormuz. Reuters reporting says traffic remained dramatically below normal, and major shippers were still demanding clarity before acting like the crisis was over. The Energy Information Administration still identifies Hormuz as the key choke point for global oil and liquefied natural gas flows. The Bureau of Labor Statistics just gave you a March inflation report with a major energy shock embedded inside it. The Bureau of Economic Analysis still shows inflation running above where policymakers want it. The Silver Institute still expects a sixth straight annual silver deficit and says the market remains reliant on above-ground stock releases. First Majestic is still allocating real capital into restart plans in a stronger precious metals environment. So when you put all of that together, what do you get? You get a world that still looks supportive for gold and silver over time, even if the short-term path stays noisy, frustrating, and headline-driven. That is my read. Could the road get bumpier first? Absolutely. Could silver shake people out before rewarding patience? Would not be the first time. Could gold spend stretches acting less dramatic than the macro case would suggest? Also yes. But if you zoom out, I think the bigger picture is still more important than the random daily candle that gets everybody emotional. Keep your eye on the Strait, keep your eye on energy, keep your eye on inflation, keep your eye on policy response, and keep your eye on silver's physical balance, because beneath all the noise, that market still looks tighter than a lot of people want to admit. Thank you for spending part of your day with me. I hope the people caught in the middle of all this get peace and relief as soon as possible. And as always, this is for education and discussion only, not personal financial advice, because your money deserves your own homework, your own judgment, and a calm mind before any decision.